Hey there, John Hunter. I'm back this week. We're going to talk about temporary buy downs and why they are a seller's secret weapon to getting your house sold in today's market. So, temporary buy downs, so what are they? Um, just like the name sounds, it's a buy down, but only for a short amount of time. So, the difference is there's a permanent buy down and temporary buy down. A temporary buy down takes the form of what they call a 2-1 or a 3-1 or 3-2-1 or a 1-1 buy down. And what those numbers mean are a 2-1 buy down means it's a 2% lower rate for the first year, a 1% lower rate for the second year, and then whatever the going rate is after that. So say like today, if the rate is 7.5, first year you get 5.5, second year you get 6.5, and then every year after it's 7.5, which was what the loan was originally. So really all you're doing on temporary buy down is you're prepaying interest you would otherwise pay. So it's a straightforward 30-year fix. It's no different than any other type of loan where it's a 30-year fixed rate, but for the first year you prepay the interest, right? For a 2% worth of interest, you prepay. And then the second year, 1% interest, you pay all of that interest up front, right? And as it equates to what we're talking about today, it's a seller-funded buy down. So what we do on a purchase is we negotiate the seller to pay a certain amount of money for the buyer to go towards a buy down, and we prepay this interest up front to get a lower payment for the first 2 years. So that's why it's a temporary buy down. So it takes the form of a 3-2-1, so 3% lower, 2% lower, 1% lower, or even a 1-1 where it's just 1% lower for the first year. And why would you want to do that, right? As a seller, because you can offer that as a concession to make it much more attractive for a buyer to buy in this market. One of the main reasons why we see people backing out on purchase transactions right now and offers, people that otherwise want to buy, is the sticker shock of not only are prices really high, but so are rates. Rates are terrible right now. We're at a 20-year high on rates we haven't seen in obviously 20 years. But to this level, with the prices that we're at, we went from a market 3.5 years ago that had the best affordability index that we've ever seen as far as rates and price and income goes, those three combined, to where here we are 3.5 years later at one of the worst affordability indexes. And it's all because of rates and prices. And wages just haven't kept up, not with inflation. So that little trifecta there makes these buy downs much more attractive than more than ever. And as a seller, you can give a concession versus having to dig deeper on a price cut. So that's really why you'd want to do that. Now, why would you want to do a temporary buy down versus a permanent buy down? Where buying the rate down, permanently for all 30 years. Well, the cost is dramatically different. So on a 2-1 buy down, you could, on a, say, a $600,000 house here, the example I'm going to show in a second, has the total buy down cost at around $13,000, right? So on a $600,000 house, $13,000, of the purchase price, that's only a little over 2% of the purchase price. Well, a 2% buy down, as far as a permanent buy down goes, would only maybe get you not even a 0.5% in rate, all right? So it's a dramatic difference than what a 2-1 buy down would get you. And the reason why you wouldn't want to do a 2-1 or permanent buy down in this market is rates are coming down. Everybody knows it. The Fed has talked about it. Probably by the end of next year, we could be as much as 1 to 2% lower than we are right now. So anybody getting a loan in the last couple months up until probably 6 months from now will not be keeping that loan very long. It will probably be 12 to 18 months, and they're going to refinance to get a lower rate. So it's getting between here and there. It's making the house more attractive and more affordable now, between now and when rates come down. And that's where these temporary buy down is the sweet spot. It's this window, 24 months roughly on a 2-1 buy down, 36 if you do a 3-1, right? And a 1-1 would be 12, right? Makes sense. So there you go. That's the basis on why you would want to do it and why it would make sense for a seller, right? Well, and I'll get into an example on that here in a second. But let me show you the numbers on how it would work with a $600,000 purchase. So let's take a look at that. All right, my first example here is a 2-1 buy down. Like we had talked about, $600,000 purchase, conventional, 5% down. If you look at the green column here, that would be the very first year. If you started at 6.5, the first year on a 2-1 buy down would be 4.5. That's a $714 a month savings for the first 12 months. That's huge. $8,500 would be the cost, $576. So for the second year, it's 5.5. So we're going to cut that savings in half. So you're looking at what, $357 roughly a month lower for the second year. And then the third year on, it's to the 6.5 rate. Now remember, rates should be dropping sometime between that first and second year. So chances are, by the time you get to the 6.5 rate, you probably won't have this loan anymore. So that's the magic to this. So you're not going to be stuck with that 6.5 rate, and it's a way you can get a lower rate between now and then. Now, as the seller goes, in this scenario, the cost of the seller would be $12,972.86. Conversely, that's also the savings to the buyer. So this makes that home infinitely more affordable. If you want to look at it from a dollar perspective, a $700 a month lower payment is probably, in today's numbers, that's probably to $120,000 in price, right? So for the same exact house, that's how much you'd have to go down in price to get that payment. So that's a pretty significant savings there. So my second example here is also, it's basically the same example. Instead of a 2-1, it's a 3-2-1. Just expands it out even 1 year, 3.5, which is what, $1,000 lower. Now this cost to the seller here bumps up quite a bit to $25,491 for the cost of the buy down, which is pretty significant. But 3-2-1 is not a bad option if it can be negotiated. There are sellers out there where this makes sense. Not all of them though. One caveat to this is, as a seller, you're limited on what you can contribute. The sales concessions are capped. So conventional, if you're putting less than 10% down, you're capped at a 3% concession, which 3% wouldn't cover the 3-2-1 buy down. And then it is at 10 to 25% down, you're at a 6% concession. And then at 25% or more, it's 9%. Now, if you're going FHA minimum down, the concession cap is 6%. And if you're VA, it's 4%. So if you're going FHA or VA, you're set. It's not going to be an issue. Even conventional, as long as you're 10% or more, even a 3-2-1 would work. If you're doing a 2-1, even going minimum down would work. But getting the seller to pay both closing costs and the buy down is rough. You can't do that on a conventional minimum down. I think on FHA you could do it, and I think on VA you'd be able to get away with it, but not on conventional minimum down. So now let's look at what it means to a seller. If you're the one selling and you want to use this as a tool, what does it mean to you? So this next chart here, we're taking a look at price reduction versus seller concession on a 2-1 buy down comparison. So that first column is if you were to sell full price, don't need to do any concessions, you'd net out, perfect world, $600,000. But let's say you're sitting on a $600,000 listing and you're faced with a price reduction. $24,000 price reduction is not a unheard of price reduction in that scenario. So if you had to do that, that's what it would net you out at the end. You'd be down 24 grand, right? Price reduction straight up. And as a buyer, if you got the price home for less money, it saves you $141 or $44, right? Which is real money, but it's $144. Now, in the third column here is what happens if the seller was to keep the price at $600,000 but offer a 2-1 buy down. What does it mean to the buyer and to the seller? Well, to the buyer, it's pretty significant, right? You're saving a ton of money in the first year. You're saving a ton of money in the second year, total of $12,972, way more than the $144 a month. And then and that scenario nets the seller out even more. So both the buyer and the seller in the first 2 years come out way ahead in that scenario. Now, and remember, even if you were to not do the buy down, after 12 to 18 months, rates are coming down and you'll be able to refinance. Any of these scenarios, I don't see anybody who's going to purchase or get a loan in the next 6 months is going to have that loan for more than 12 to 18 months. I just don't see a scenario. So if that's the case, why not leverage this to get the lowest payment between now and then still get the lower rate down the road? So getting 2 loans is not a great proposition for anybody who wants to do that. Well, one thing we are doing to help lessen the blow on that is we are doing what's called a 5-year protection pledge. What the pledge is that if you refinance with us within 5 years, we will actually waive all lender fees and not charge for an appraisal. So that's a little concession that we're going to give, and we can do that because we service the loans. Hopefully that makes sense. I think it does make a ton of sense given the fact that rates are going to drop. Going forward, I don't see anybody holding on to any loan that they do for any length of time. And this is a wonderful way to get past that objection of the high rates and high payments that people are dealing with right now and be able to get that lower rate and better terms that everybody's looking for, can set your home apart and get it sold. And as a buyer, it is a way to get into this market without having that huge sticker shock that everybody's dealing with right now that's keeping a lot of people on the sidelines. So hopefully that helps. Hey, if you like the content, please like and share. I'll be sharing more of these every week, and I'd love to hear from you. Please comment or set a calendar invite down below. If you want to chat, if you have any questions, want to see how this might work for you, I'm here. John Hunter, I'm your mortgage guy, and I will talk to you soon. Bye-bye.